Bitcoin is more than doubled. Trump has gone on record talking about how he wants to deregulate and unleash crypto.
Deregulation, inflation, and kind of contradicting policy actions or some promise of policy actions. You put all these three together, you get a volatile market, and that's where probably we sit now, right? It is not that, if Trump comes up with some idea, it will be implemented in no time. Probably we'll be getting more headlines.
Or tweets, rather.
Or tweets, yes. For tweets, it's going to be a little bit more volatile than you expect. The market will give you opportunities to invest and take benefit of that.
You now have this DOGE thing he set up by Trump with Elon Musk and Vivek Ramaswamy, charged with the responsibility to reduce the role of the state, cutting down government spending to almost 2/3.
I mean, if that happens in longer term, it is actually good, right? You'll have the short-term pain. Like if you take out 6.3 trillion, you take out 4.3. But it's much harder said than done.
People have been calling out for America getting into recession, which never came. And what's the secret behind American economy holding up like this?
The amount of data that are being fed into the system, ability to take decisions have actually probably gotten much better and maybe a little bit more logic driven rather than kind of more driven by whims. I'm looking forward to a very interesting next 3 to 4 years actually.
Hello and welcome to the first ever episode of Marcellus Musings, our newest podcast. My name is Pramod Gubbi. I'm one of the founders of Marcellus. I will be discussing all things economy and markets with various colleagues of mine through this series. For today's episode, I have with me my colleague Arindam Mandal, who heads our Global Equities business. The reason I thought it'll be interesting to speak to Arindam now is the impending inauguration of the American presidency of Donald Trump next week. Makes it a lot topical to understand what's in store for all of us. Arindam has spent more than a decade living in the US, managing US money, perhaps through more than 4 or 5 American presidencies, Arindam. So he's lived and breathed that. So it'll be interesting. I'm sure he'll have some interesting insights to talk about. So, Arindam, here's what's transpired in the last 4 or 5 months. And I think around September, October, as it started getting clear that Trump's got the lead and likely to win, although until 5th November, I don't think anybody expected the extent of the win. People had already gotten sense to the extent that markets are forward-looking. We've seen certain developments in the market. I'll start with the most spectacular of them, which is crypto. Bitcoin is more than doubled during this period. This perhaps is the easiest to explain. Trump has gone on record talking about how he wants to deregulate and unleash crypto. Second, and no less spectacular, has been the bond yields. Very much against expectations. We began the year thinking that we'll have very sharp rate cuts. But since September, you've seen US 10-year bond yields rally almost 100 basis points, which is taking us back to the 2023 peak, actually. Here again, to my little understanding, I presume it's Trump's tariff-based policies being seen as inflationary by the bond markets, and therefore the possibility of future rate cuts being less, or possibly the tax cuts that he's talked about suggest that the markets are factoring in a widening of deficit, and hence the bond yields reacting the way they are. And finally, everything that we're involved in, which is the stock market. Stock markets have also rallied quite handsomely. Actually, the last couple of weeks have been sort of a pullback. I see now the S&P 500 is actually back to where it was on the day of the election. But I guess the run-up ahead of the elections should also be counted. What do you make of all of this when you look at managing money?
No problem. Thank you. Happy to do this podcast, actually, and quite timely, as you mentioned. Now, you touched on all of these points. So deregulation, inflation, and kind of contradicting policy actions or some promise of policy actions, if I can put it that way. And you put all these three together, you get a volatile market, and that's where probably we sit now, right? Uh, Now, having seen a few of the earlier elections and how they have panned out, or even if I just think about 2016 to 2020, taking out the COVID year, um, I mean, probably, some of the actions or some of the kind of executive orders that you typically get on a daily basis at some point of time. But what I've noticed is that, there are broad guardrails that are in place, right? It is not that, if Trump comes up with some idea, it will be implemented in no time. So the guardrails that are being established, I mean, they're quite solid. They have been there for many, many years. So that, I think, keeps things on check. But having said that, probably you'll be getting more headlines than you probably got in last
Or
few
tweets
years.
rather.
Or tweets, yes, more tweets. Um, so that probably makes you awake at night at times. It's going to be a little bit more volatile than you expect. But at the same time, I mean, I think as an investor, what you can do is focus on the fundamentals uh, and keep investing, right? I mean, the market will give you opportunities to invest and take benefit of that. I mean, that's what I learned from 2016 to 2020, right? A lot of noises, a lot of headlines. 2018, if I can recall, from June to end of that year, 2018, market was down big. And eventually the fundamentals actually triumphed. Next 2 years, or actually before COVID also, it turned out to be pretty good. So yeah, my only view is that just try to find out the signal out of that noise that would come through. But yeah, I'm looking forward to a very interesting next 3 to 4 years actually.
Yeah, no, I remember the last Trump win also brought in um, very different realities compared to the expectations in the run-up. I think the expectations were exactly the opposite. The Trump win brought in weakness in the markets. The markets fell towards the end of 2016, but 2017 was a spectacular year. So I guess some of these things are more for entertainment and discussion than actually proper fodder for investment decision making. Having said that, I guess the strength of the economy still is a critical input into investment decision making. The sort of sectors that you focus on, the stocks you pick up, will require some sense of the demand environment. Um, Now we started 2022 with a spate of rate hikes. And pretty much ever since, people have been calling out for America getting into recession, which never came. Um, and we are looking at bond yields pretty much back to those peak levels. What do you make of the state of the American economy and the strength of I mean, the rise in these bond yields having an impact? Um, what's, I mean, is this something that you expected? And what's the secret behind, American economy holding up like this?
Well, I mean, to your point, I mean, the September to December, that bond yield went up from 3.7 to 4.7, like more than 1 point actually. That actually was quite surprising because I have never seen Fed cutting rates, and at the simultaneously actually that day the bond yield actually bottomed. So that was actually quite new for me. Uh, Now the resilience has actually, quite intriguing. I mean, we definitely thought that the economy will be slowing down, but that never happened. Now I have, you can come up with different explanation, and one of the explanation that I have is that the amount of data that are being fed into the system, not on the system like when you say the system that involves corporates, systems that involve actually the individuals. So we are actually seeing the data on a daily basis. So the ability to take decisions have actually probably gotten much better and maybe a little bit more, I would say, kind of more logic driven rather than kind of more driven by whims. So in that sense, I mean, if you think about it, the economy is growing at around in real terms close to 2.5 to 3%, and that has been the case for last 1 or 2 years, which is very steady. I mean, that's what you expect a developed economy, growing at 2.5 to 3%, right? The job, if you look at the unemployment rate hovering around 4 to 4.5, in fact, Fed wants to bring it close to 4.5 so that the job market is not, that tight that it actually gives you inflation, right? And if you even look at the corporate markets, I mean, there is no doubt the liquidity. Corporates are not, there is some news here and there, but corporates are broadly are doing okay, even if they're not doing great. There has been a clear bifurcation between two groups. Like we always discuss about this K-shaped recovery in consumer, like rich and rich getting richer, etc. Similarly, on the corporate side also, if you notice, I mean, the smaller firms, they are not creating that many jobs. So the jobs are being created by the larger firms, right? And to some extent, the government is creating some jobs too. Now, I think that is where the notion of rate cut was important for Fed, because if you think from Fed's perspective, there are two things that you want to make sure that the economy is hot enough that all the sectors are actually creating jobs. In fact, the smaller side of the businesses, they should be creating jobs, because we hear about the Metas or the Googles or the Apples of the world, but the practically around 45 to 47% of the total employees, right, total workers are actually employed by small businesses, right? So if you are cutting rates, that basically incentivize them to, to bring their interest costs down. As a result, probably you hire more people, like, right? So that was one of the goals. And secondly, the residential market, right? So residential market is around 16 to 17% of the total GDP, right? It is still pretty big. Now, if the rates stay at that level, 4.5%, 5%, so you're looking at a mortgage rate of around more than 7 now for almost 2 years. So that market, even though it is holding up much better than you think, but at the same time, there is no growth at that market, right? So if you want to kind of revitalize that market to some extent, right, that is one of the goals that we would have. So probably that is why they cut rates. Now, one of the things that I hear from people is that there is a reasonable argument that the economy is doing well. Then why really want to cut rates? Just keep it like that. It is fine. But on the other side of the table, the reasons I told you, like you want to incentivize your smaller companies, because at the end, I mean, they're the backbone of the economy, right? That's what it holds up. So it's a fine balance, to be very honest. Clearly, what Fed is thinking, the market is not thinking. They're not in sync. At least, the bond actions is kind of showing that. But broadly, we have seen many times in the history, you go through these jitters, but at the same time, you find ways to come out of it. And there are definitely silver linings that you can see, at least some part of the economy going forward. So
Yeah, the employment
yeah,
numbers you talked about were indeed the recent print was also spectacular. I think
yeah,
surprised everybody again. But one of the nuances in employment, you talked about smaller businesses employing 45%. I came across this data point that almost 15% of the employed workforce is by the American government. And in the year 2024, almost 22% of the jobs that were created by the American government. That itself was surprising to me, given America has adopted a free market, capitalist sort of an economy. The heavy involvement of the American government was surprising. Having said that, you now have this DOGE thing, the Department of Government Efficiency, set up by Trump with Elon Musk and Vivek Ramaswamy, charged with the responsibility to reduce the role of the state. In fact, they've set a target of cutting down, government spending to almost two-thirds.
yeah.
That will inevitably hurt the job market if the U.S. government contributes so much to the employment, and you're now seeing a period where you will cull the U.S. budget.
I mean, if that happens in longer term, it is actually good, right? I mean, you'll have the short-term pain. Like if you take out 6.3 trillion, you take out 4.3. But it's much harder said than done. In fact, I think a few days back I saw that number, 2 trillion number, actually came down to 1 trillion, right? So again, look, I mean, these are government entities, and if you think about it, almost the discretionary spending, if my numbers are right, is around 1.7 to 1.8 trillion, or say close to 27%, 28% of that 6.3 trillion basket that you're looking at. So cutting that number, it is much harder. The other part, like the 4.6 trillion that that goes into the other things like Medicare, Medicaid, things like that, pension. Cutting those numbers are actually way harder than you think. In the discretionary side of things, you can probably cut, but that is not going to move the needle that much, and it's very hard to do that too, right? But at the same time, if we can take out some cost out of it, it will be definitely good in longer term, right, from the deficit perspective. Having said that, I mean, you made that point that 15% of workforce broadly that is employed by the U.S. government. True, but that number has been actually coming down over last few years. Actually, last decade, if I look at it. Of course, you had this last year when the small business actually didn't add anything practically to the job market, right? So it was just the government and the large firms which added some workforce. That's why the numbers look a little bit bloated. But if I look at like the numbers that was there in 2010, the total number of workers employed by government, that number is more or less same what it is today. Probably it is up 1 or 2%. So if you look at a percentage basis, it is coming down. But yeah, I mean, if DOGE can do something that you slash it much quicker, it'll be good to. I mean, it'll be good to see if they can do it. But it's much harder than you think actually on paper.
Yeah, fair point, fair point. But essentially what you're saying is the bond markets are reflecting the strength of the American economy. You've also got the inflation print coming in a couple of days ago, which was quite benign. So you've got the economy in great shape, inflation is coming down. What's the rush to cut rates, right? Now, this American economy being in great shape, despite the 2022 rate hikes were the sharpest we've seen in 40 years since Paul Volcker, 5 percentage points in a span of 12, 14 months. Yet, the best of economists have been calling for a recession and have got it hopelessly wrong. Is this what they call American exceptionalism? Is this what Buffett means by saying never bet against America? We've had a lot of consensus coming up. Clearly, from a markets perspective, the American stock market has outperformed the global markets by almost 6 percentage points for 15 years in a row. And it's almost becoming a consensus trade that, everybody wants to bet on America. I mean, China was a close alternative till recently. Europe has done well last year, but if you look at the long run performance has been pretty abysmal. So it is becoming consensus thinking. So there are a few pockets of contrarians emerging, most notably Ruchir Sharma, who recently wrote in the FT that this is going to be the end of the American exceptionalism, or at least temporarily. And he makes a pertinent point that historically you've had America outperforming the world for a decade and underperforming for another. You've never had sustained outperformance. We are now 15th year into this outperformance. Which side of the debate are you?
I mean, yeah, I mean, I read that article, quite a few fascinating points that he actually made there, right? You're right. Every 10 years, the leadership changes in terms of which market is outperforming. 1990s, 1980s, Japan took over. 1990s, US claimed it back. 2000 emerging market, 2010 US claimed it back, right? Fair at that from that standpoint, and I totally agree. I mean, this crowding is a little bit scary for sure. There especially crowding in certain sectors, certain themes that is definitely scary. Now, I would say one thing here, that when you say US market, I'll not really restrict myself at just looking at the US index or the S&P index or NASDAQ, right? Not at the index level. Typically, there is a big market, that is there beyond the top, say, 7-10 names, which primarily consists like that consists like for 40 to 50% of the total market, right? If you look at the market cap weighted basis, or if you look at S&P 500. But there's a huge chunk of, there's numerous companies beyond that. I consider that as a market when I'm looking at US market or its exceptionalism. So, I mean, one of the points that you make, for example, you talked about every 10 years, the leadership changes. Now, we have to also remember one thing, that not any other geography practically could reclaim that leadership, right? So that is one of the things about greatness. Like if you talk about Apple or if you talk about Microsoft, we say the same thing, that not many tech companies could reclaim the leadership the way they did. Similarly, not many countries could do that. So that talks about, there is something special that happens here. We'll see, how it plays out over next decade or so. Having said that, now let's go back to the time frame. Like if you think about 2000 to 2007, if you look at the index level, the index was practically flat. We peaked in 2000, 2007 at index level, nothing really happened just before the recession. But during that time frame, if you just look down below, I mean, we could see in the Russell 1000, which is basically the large and mid cap index of US, more than actually 100 stocks which doubled in their value, and it had like the likes of say Caterpillar, it had the likes of John Deere, right? It had the likes of few other, like Apple 7x actually during that point of time. At that time, Apple was going through a tough time during the 90s, so it kind of reclaimed its position back then. So the point is that my go-to market would still remain the US. The sole reason being, it it has the ingredients to play for every style or every theme that is absent in most of the other markets. You look at any other market, most of the markets are actually very monolithic. In US, that is not the case. For example, I mean, as I said, like, of course, I mean, the top 7, 10 companies, they might go through a correction, something can happen, but you'll definitely find a lot of companies that can actually compound at a very healthy pace, even if the broad index doesn't do much, right? In fact, what I liked about that article, the thing that Ruchir actually mentioned, that if it really happens, I mean, it'll be great for active managers. In fact, active managers are actually struggling for last, 10 years at least. And I've seen them really, I mean, the top names are driving everything. So there is actually practically no value at for stock pickers, right? So if we go back to that kind of scenario of, 2000, 2007, or say 1980s, if you remember, 1980s actually, Mr. Buffet kind of, 82 to 90 was his best time. If you think about Peter Lynch, great time from 84 to 90, right? So they built their legacy during those times because that was a stock picker market. So if those things happen, similar kind of things happen, that's actually pretty good for people like us, right?
Yeah. Yeah, but no, so look, absolutely right, because you've made the point in the past as well. While the S&P 500 might be trading at its all-time high multiples, cyclically adjusted P/E ratio, which has had a good track record in terms of calling market peaks, is also back to almost dot-com levels. But the S&P 500 on an equal weighted basis is not that expensive, or the S&P 400, which is the mid cap, the Russell 2000, are indeed trading at below long-term averages.
Yeah.
Now that seems to suggest that rally has been very concentrated. I don't think there's any blinding insight in that. A lot of people have been talking about the polarization of the market. First question I want to talk about is, some argue that the tech companies have rallied, but unlike the dot-com era, it's also been justified by the earnings growth. Some of the earnings growth for the likes of Nvidia and Apple, Amazon, Google has been fairly spectacular. So how do you not extrapolate that dominance? And again, Richard makes another point about American economy contributing 30% to world GDP, but the American stock market makes up almost 75% of the world market cap. But if you have American corporates in the stock market dominating the global economy, isn't comparing American stock market and economy comparing apples and oranges?
Look, I mean, that buffet indicator, right? Market cap to GDP that we used to talk about. It was in a time when the economies are more closed, right? So when you think about US stock market, it was US. You're talking about US economy, so it made sense. You practically make around 10% PPT, profit before tax margin. So you put a 15% multiple on your final earnings, you get a one-time price to sales, right? That is practically your market cap to GDP. So that equation changed significantly in two ways. Number one, right now it is not, we're talking about global economy. We talk about Apple, it's far from being an US story, right? Half of your market is actually outside of US. So that is number one. Number two, if you just look at the free cash flow margin, right, of the indexes, that has actually gone up massively.
Yeah.
Right. Some of that can be attributed to the fact that there are some tax cuts in between from last 30 year back or what you see now. But it is also a function of the fact that the all these businesses, the high flying businesses today, they're actually capital light, asset light business, so they generate actually a ton of cash. In fact, if you think about the Cisco's of 19 late 90s or early 2000, we are always talking about earnings. Cash is something not anyone talked about. But if you look at the Nvidia of today, we're actually talking about their entire earnings is actually cash, right? Nvidia is making a EBITDA margin of around 60, 62%, probably a net income of margin of around 50% or so, more than that, right? So, and this is entirely converting to free cash,
Cash. Yeah.
right? So that is a huge difference, right? That is a huge difference from what I've seen. So that 30% of the total GDP going to 70%. I think that is something we probably should relook to some extent. And the fact is that this expansion in profit margin has happened mostly in the US, not in the rest of the world.
Yeah.
Primarily because US kind of getting from this tangible asset driven businesses to more intangible asset driven business. Just to put it simply, Nvidia makes everything, but it actually doesn't manufacture anything, right?
Yeah.
It is manufactured by TSMC. So this business model is sustainably probably you can argue that it has made the multiples little higher than it has been historically. Now the
Yeah.
counter argument you can put that uh, given that we are going into more in isolation driven world, like you do your own stuff, then probably some of the margin that you have expanded over a long period of time because of the globalization, that might you have to give up something like that. We'll see, how that takes place. But what I've seen is that if anything is taking place gradually, US is actually pretty good at adapting to those changes historically, right? If something happens all of a sudden, right? If TSMC kind of closes their doors, like driven by something that we don't know, then yes, then there's definitely a shock to the system, right?
Yeah.
So yeah, to simplify it, I think there's clear logic why that 30% of GDP actually is 70% of or 70% of total market cap, uh, and we have no clear evidence as of now that it can change soon.
Fair enough. Yeah. I mean, the reason we're struggling to see how it can change soon is the other big difference between now and the 80s, when Buffett and Lynch were making alpha in difficult markets, which is the growth of passive, right? 2023 was the first year when passive funds in the US overtook active funds. And passive funds are in some ways self-fulfilling because they track market cap based indices. If an Nvidia does well, its weight in the market, weight in the index goes up. So therefore, all the funds, which is now more than 50% of institutional money, will have to buy more of Nvidia, which itself will push up Nvidia's prices, and then you're on a virtuous cycle. I think it was Cliff Asness who wrote a beautiful paper a couple of months ago about how this is creating a very unique market structure which we haven't seen. Theoretically, he made the same point that you're making. This should actually be good for active managers because it creates inefficiencies. But he also said that it may require a lot of patience for the whole thing to unravel for particularly value focused investors. How do you deal with that? You're tasked to deal with something that even Buffett and Lynch didn't have to deal with.
It has been tough. I mean, we're just looking through, like we have launched the fund 2 years back. Just doing a review of last year, what happened in 2024. So typically you'd see that if the earnings growth of your company, and I'm talking about forward earnings growth of your company, right? So not lagging is doesn't make that much sense in a 1 year context. So forward earnings growth throughout the year for our companies, you actually did much better than what the S&P's forward earnings growth. Throughout this time frame, we saw revisions on those earnings, right? But given that you are not part of that cohort of mega cap cohort, many of our stocks actually didn't see the re-rating. So their return was at par with what their forward earnings growth was, which is fine. I mean, that's what it should be. But when there is a massive force, when your earnings are going for certain companies like 50%, but your stock goes up, say 70%, right? So that is the re-rating component. So you miss out on those kind of segments. But having said that, look, I mean, we never know when these things are going to turn. What you can anticipate is that eventually fundamentals will come back. But at the same time, look, uh, if there's a huge disconnect between the earnings growth and the the share price return, then would have been more worried. There is some disconnect, but it is not at an astronomical level yet. To some extent, like for example, Nvidia's earnings expectation went up twice. The stock is up thrice. You can probably say some of it, but it is not. There are some companies like Palantir or Tesla of the world where we see this kind of craziness, but it's still quite rational in terms of the broader market. So you have to remember one thing: like when these things unravels. Like for example, if we think about 2022, you don't have to go too much back, in the history. When this thing unravels, the volatility also is much higher. So a mega cap stock can go down 30-40%, which is typically, not the case if you think about a market drawdown, right? So so it plays in both the ways. Just for us, I think just keep your head straight and take a 3 to 5 year view. Unless we are living in a kind of situation which is completely brutal. We have seen few of those instances in history. I think eventually over a 3 to 5 year period, these things get normalized.
Yeah. I mean, you make the fair point because the same self-fulfilling virtuous cycle can turn into a vicious cycle, which we saw in 2022. Actually, the big caps fell a lot more than the broader market. The Nasdaq fell a lot more than the S&P 500. So yeah, I guess you need that trigger. Currently, looks like the trigger is far off, given the entire hype about Gen AI and all the hyperscalers investing and so on. So what I get is eventually earnings growth will drive stock price returns. You need to be conscious about valuations. And what I can see from your portfolio, you position more towards mid cap and industrials. You are heavily underweight tech. So you are making a big, bold call. I know you talked about that hurt you in 2024 in terms of performance, pretty much the last 1 month. But your 2 year performance track record is still, still better than the index by a reasonable amount, without having to have played tech the way the market is played. How do you sort of justify your positioning on mid caps and industrials?
Yeah, look, one of the goals that we have for this fund is that we want to find out what you call golden nuggets, right, from the market. And I'm not saying that you're doing it just for the sake of doing it. That is, they don't have probably any earnings growth, you buy them. No, that's not the case. What we have understood over time is a mid-teens earnings growth is actually an exceptional, outcome for most of the companies. Corporate America's profit grows at around 7%. And it is not last 4 or 5 years, that has been the case for last 50, 60 years. I mean, it kind of corroborates with the nominal GDP growth. Nominal GDP growth, is 5 to 6. You get a bit of operating margin expansion. And on top of that, in today's time, you get a bit of buyback or dividend. So that is the typical growth algorithm that is unlikely to change much. If we can get something that can give you mid-teens kind of CAGR, that are actually great for us. We are not shooting for the moon. Our comfort zone is that for now. Your point on industrial. So I started my career as an industrial analyst. So I might be a little biased. In fact, I was not that happy about it to start with, because I was a software engineer when I was by profession before going into MBA. And I remember, like, I used to work for Oracle, and we used to get that email right after every earnings call that the top line grew by 10%. Now, when I came into the land of industrials, I would say, the 3%, 4%, 5% top line growth, that was like the norm, and they're actually high quality companies. And I really never understood, like, at that point of time, that why I'm covering such a low growth kind of companies, etc., etc. Um, then eventually understood that, the capital allocation piece in investing, why it is so powerful. And we can apply it in so many ways. You can apply it at country level, why US outperforms many of the major growth countries. You can apply in sector level, why certain sectors do well compared to many of the high flying industries. You can apply in the company level, right? I give an example of, for example, AutoZone versus Salesforce. Boarding auto part retailer, right? Practically going at 5-6%. Look at their 10-year performance versus Salesforce.com. Practically everyone knows and uses Salesforce in their office. AutoZone has massively outperformed Salesforce. The same AutoZone kind of philosophy actually applies to many of the industrial companies. In fact, I think you forwarded me that list of companies in S&P 1500, which is basically the top 1500 companies in S&P, which are profitable companies. And out of that, if you wanted to look into that top performing companies in last 25 years, and when you think about 25 years, that is actually the boom in tech. We're talking about 1998 to 2023, or 1999 to 2004, 2024. Boom in tech. Out of that top, I think 30 or 40 companies, I'm forgetting the name of the total number of companies. 9 were actually industrial companies, 7 were actually tech.
Yeah, highest from any sector was industrials.
Yeah. So that is the fun. So, like, as I'm saying, like, in industrial is kind of perceived as a sector which is always flying under the radar. They're not going to give you 30% top line CAGR or 25% top line CAGR. They will give you 7-8% of top line CAGR. With that, we get good capital allocation that can give you another 6 or 7. That takes you to around 13 to 15, 13 to 16, right? And you get them in a pretty reasonable valuation because they're always flying under the radar. Like, for example, last year, many of our companies didn't see any re-rating. For example, a company that you own, Heiko, I think it returned around 25 or 30% last year, and the earnings growth was similar. Same with TransDigm, gave similar kind of return, no re-rating, just because of their earnings growth and dividend yield. That's what you're looking for, so you can do it longer time, you will eventually come out as a winner. That's what our base case is.
Yeah, I guess in some ways that's what you need, more consistent compounding available at reasonable valuations, whereas the tech gets a lot of attention and tends to swing on either side of the equilibrium a bit too much and makes it harder to time, whereas industrials could be could be more consistent that way. That's the beauty of boring businesses. Nobody likes them, and they don't tend to get overrated.
One of the major, I think, the disconnect that I have seen over time, and that happened to me as well, people confuse the growth in market cap versus the shareholder return. They're two very different things, right? Market cap uh, at the cost of diluting your existing shareholders doesn't mean anything actually, right? At the same time, you're not growing your market cap, but you're benefiting your existing shareholders by buying back or dividend or whatever you do. That actually adds a lot of value, which the market doesn't bake in when they're pricing a business.
Yep, fair enough. Um, so I guess you might even have a tailwind if Trump's "Make America Great Again" policy presumably involves reindustrializing America, right? Given that through COVID, the West has figured that there's too much, reliance on China and Southeast Asia for manufacturing. Um, if the tariffs and other policies reindustrialize America, could be a tailwind for industrials. Who knows? Industrials could be the next tech. On that lighter vein, I would like to conclude this podcast and wish you all the very best for your AIF launch next month. I think if you can sustain the sort of returns that you delivered in the PMS over the last 2 years, it should be a great launch. So all the very best, and we shall talk again soon. Thanks,
Thank you.
Arindam.
Thank you, Pramod.